The price of Bitcoin suffers a significant fall following the hike on May 4th. The reasons lie in the macroeconomy, which leaves us with considerably worrying data. As we saw in our previous analysis, in the monthly timeframe, it was important to maintain the range between $37,000 and $47,000. We also saw how the importance of not losing the 20-period moving average, although this did not happen and April's candlestick closed below that average. In the weekly timeframe, we can see a zone of significant consolidation in which the price of Bitcoin is found. Over the last few weeks of March, we can see how it reached that higher part of the range and formed an evening star pattern. Once that pattern was formed, we saw a bearish movement in which 6 bearish candlesticks had already formed. The last candlestick managed to reject the $37,000 zone and closed above it. But this week, it has carried out a fairly volatile movement, and yesterday extremely relevant news was revealed, which we'll be going over shortly. Right now, the price could head toward the $34,000 zone, a whale accumulation zone. With the deployed moving averages, we can see that the price has gone on to touch not only the incredibly important support zone at $36,500, but also the 100-period moving average in the weekly time frame. The 20 and 50-period moving averages had already crossed each other 4 weeks ago, while the 100-period moving average continues to ascend. But if the 20 average crosses that of 100, it would be a considerably negative sign. And if we take a look at this week, the 0.78 Fibonacci level has also been lost, which had previously served as an opening and closing point for the candlesticks from February 21st to March 21st. In the daily time frame, we can see with more clarity the market structure, which has been marked by the Fed's decision to increase interest rates. The market reacted positively in that moment. Why? Because it was expected, and markets prefer certainty rather than surprises. But then, why did this fall occur? In the daily time frame, we can see the market structure. In this chart, we have presented Fibonacci's extensions from the session's minimum. Watch out, here we've drawn Fibonacci's extension from January's lower point, where the structure starts from $33,000 to $48,000. In the chart, we can see the parallel ascending channel where important resistance zones were reaching the higher part. From the end of April, the price has been losing 0.38, 0.50 and 0.61 of Fibonacci. This 0.61 has to be maintained as it coincided with the previous zone of lows. If we zoom in slightly, we can see that once the $42,000 zone was lost, a small range started forming, which was being lost and is now forming lower lows and higher lows. In other words, an intermediary trend that has not yet lost the zone of macro trend lows. It is worth noting that at this moment the price sits in an important support zone, the last defense line before going after $34,500. In this defense zone, we can see the lower part of the parallel channel and 0.78 Fibonacci. Something important that we must keep in mind when carrying out an analysis is the harmony between effort and result and the price. In other words, looking at indicators with strength in the market such as the RSI and its movements in regard to the price's actions. Between April 11th and 26th, we can see a divergence, but over the last few weeks, we can also see a divergence that continues to extend itself. As long as the RSI doesn't lose the 36-point zone, the divergence will continue and the price will tend to revert the downtrend at least in the short term. Supposing the RSI is lost, we'd go on to look for the $33,000 to $34,000, where that whale zone converges. Following the Fed's decision on May 4th, Bitcoin reached the higher part drawn by the lower highs. Specifically, it reached $40,000 with an important volume input, slowing down the 20-period moving average. However, yesterday, May 5th, we saw a bearish engulfing candlestick due to a news announcement, also with noticeable volume input. Here, we can appreciate the strong relationship between traditional and cryptocurrency markets, and that's why we always say it's important to combine the technical, fundamental, and on-chain analysis together. In fact, in the SP 500, we can see bullish candlesticks following the Fed's news and a strong fall on the 5th. The correlation between this market and Bitcoin is more than evident. We could say that they're pretty much identical candlesticks. In the zone of lows, similar to Bitcoin, we're seeing buying interest which currently resists the fall. In the dollar's case, we're breaking the zone of highs. If we take a look at last week's candlestick, it closed above the resistance formed by this large macro range in the chart. If the price gains that zone, it could lead to higher levels. In addition, the 50 and 200 period averages are about to cross each other on the upside, the so-called golden cross due to its bullish connotation. This trend is caused partly due to investors selling bonds and actions while they take refuge from volatility by turning to the fiduciary markets. The news of the week in the macroeconomic context is the rise in interest rates by the Federal Reserve. The Federal Reserve sticks to the script and decides to raise interest rates by 0.5 basis points. The aim? To contain inflation, which is now skyrocketing in the United States and places itself at 8.5%. Markets reacted positively. As we've seen, S&P 500 increased by over 2% and Bitcoin also reacted positively. Over the last few months, their strategy seems to be very clear. Be sufficiently predictable in order to avoid panic in markets and negative impacts on the economy. The Federal Reserve has also warned that it will cut its balance sheet. What does this mean? That it will stop injecting liquidity into markets with the purchase of mortgage bonds and government bonds. But the Fed also warns that there will be 3 new increases in interest rates this year, and the market could be discounting these increases, which will be carried out throughout 2022. But if we look back, we can see that when the Fed was intervened forcefully to contain inflation, it caused recessions. Therefore, it will have to treat this very carefully in order to avoid making it worse. That said, let's look at some data to get a better understanding of the macroeconomic context. Here's where the why of the fall comes in. The US core CPI stands at 6.5%. The core CPI is a consumer price index that excludes food and energy. Therefore, it eliminates from the equation the products most used by consumers. And what is this 6.5% figure telling us? That inflation is not only caused by the supply chain, the war in Ukraine, etc. Those are the factors that mainly affect food and energy. And removing those elements from the equation, we see that it continues to result in a very worrying figure. An important date to keep in mind in regards to the consumer price index is May 11th. But pay attention to this data, which is extremely worrying and has affected markets, provoking the fall seen yesterday in the S&P 500. This involves non-agricultural productivity, which is calculated by dividing the gross domestic product by the number of hours worked in the United States. This data is usually taken as an indicator of the economy's health. But in the first quarter of 2022, it was minus 7.5%, which shows that the situation in the economy is not exactly positive. In fact, it is the biggest drop since 1947, shortly after the end of the Second World War. And this is the data that has generated the fall in the S&P 500, as well as the Bitcoin market, because we know the price of cryptocurrencies is being linked more and more to the movements of the traditional market. But it doesn't stop there. Unemployment benefits in the United States has increased more than expected, reflecting weakness in the labor market. This is very dangerous, especially if it is combined with the Fed's decision to increase interest rates. The economy, according to the Fed, is doing well despite inflation, which is why they've decided to increase interest rates. The aim of the rise in interest rates is to contain price levels, but on the flip side, it tends to go hand in hand with the halt in the economy's growth, and even a recession. But watch out! If the high levels of consumer price cannot be contained and economic growth slows down, we run the risk of suffering stagflation. In other words, inflation sustained over time combined with an economic decline. This is why some believe that the Fed's monetary policy should be more lenient in order to avoid causing an impact on the economy. This is what's known as dovish. On the other hand, Bitcoin is gaining more and more popularity. The Central African Republic has just approved a new law that accepts Bitcoin as legal tender. But the International Monetary Fund seems skeptical and claims it poses legal and transparency challenges. These speeches somehow influence the Bitcoin market. In addition, the markets remain in a state of extreme fear, according to the Fear and Greed Index. And now, as always, let's look at data obtained on the blockchain. In this chart, we can see that the withdrawal of bitcoins from exchanges continues, something that could indicate that investors continue to accumulate their cryptocurrencies in cold wallets and therefore have no intention of selling them. We could take this data as something positive, at least if we look at them in the medium and long term. And investment funds in the month of May have been increasing their exposure to Bitcoin despite reducing that exposure by 20% the previous month. Pay attention to this data, as we could start seeing a capitulation of the miners. What is capitulation? It involves miners giving up profits by selling their accumulated bitcoins or even selling more bitcoins than those generated. This capitulation or this surrender usually occurs in moments of prolonged falls, in moments of panic. In this chart, we can see the number of long positions that were liquidated, which have reached $164 million. In other words, those that positioned themselves in long lost yesterday's abrupt fall. And an element to take into account in the analysis is that of Bitcoin holders in the short term, those who have just entered the market. In this chart, we can see the average price of holders in the short term is at $46,000. So right now, those holders who are also usually somewhat more inexperienced when they're in a state of panic and sell their assets. The Z-score indicates the difference between the purchase value of these short-term investors and the current price. And this indicator, when it's negative deviations, like now, it's a dangerous thing because these short-term investors are most likely to sell in times of panic, which drives the price down. In short, the Fed's decision, which has met expectations, led to a boost in markets, but the disastrous macroeconomic data in the United States has caused a great correction. In addition, as we have seen, short-term Bitcoin holders are the ones that can somehow continue to push the cryptocurrency's price towards the downside, as they're the most influenced by fear.